Welcome to the Foundry, where leaders are forged daily. And now your host, George Roberts.
Welcome back, entrepreneurs. Today we have Philippe Schulligen, founder of Boost Capital Group. Welcome to the show, Philippe.
Thank you, George. Happy to be here.
Excellent. So I'd like you to give us, our audience, an opportunity to get to know you a little better. Tell us, who is Philippe Schulligen?
Well, my name is Philippe Schulligen. I'm born and raised in France, and I came to the US about 20 years ago for my W-2, working in business aviation, and had a great career there. Mm-hmm. And so back early 2000s, actually, I came across, there was a special, I think, on PBS from Robert Kiyosaki talking about the Rich Dad, Poor Dad. And it's kind of, I became very interested about having a side hustle, basically in investing or doing a business, except initially I didn't pick real estate. I think that was my mistake. I came to real estate a little bit later, end of 2016. Did purchased a couple of turnkey single-family rentals, and realized back then that scaling was going to be slow going on that route. So I came across multifamily and took a course on acquiring multifamily real estate, and found a deal. I found some partners. And since then, I was able to quit my W-2. And so I'm doing this full time. I'm also now a mentor. I ended up being a general partner in about 2,000 units. So in a nutshell.
Great. And so you mentioned mentorship there. So I know you started out in the Michael Blanc program, and then you ended up becoming one of his mentors. So obviously somebody who's happy having gone the mentorship route. Can you explain what that was like for you, and maybe some of what you're doing?
Yeah, sure. So, actually, I ended up having a working with a mentor on a particular deal. So, I think back then the mentorship program was just starting. So, I was, with the partners I worked with, they assigned with me somebody who was a little more senior, where I had the opportunity to run the deal firsthand. I had like a co-pilot, an experienced co-pilot next to me who was able to guide me through the different steps, right? And, avoid any pitfalls and so on. And I think that's the great power, the great strength of a mentoring program. When you want somebody with experience who can lead you and avoid like costly mistakes, which eventually had some when I tried to do some take some risks down the road. But it always, I think there's great value in having somebody lead you step by step, and instead of kind of second guessing yourself or being in a situation where you're taking too many risks.
Yeah, great. Somebody to help you through the pitfalls. So I know one of the other things that you promised to talk to us about today would be maybe some difficult deals, some hurdles that you've overcome. Can you tell us about maybe a difficult deal that you were able to get back on track?
Yeah, so I think the difficult deal is I would take like as a more general advice on this, or experience that my personal experience on deals. I think you don't want to end up, even when it's a good, everybody's in good phase going into some kind of deal, you don't want to end up being the first. Because, for instance, in the deal that didn't work out for us, the more senior partner was working with us. He kind of led us on the path of getting an equity partner to take over a larger deal. However, he didn't have experience, that more senior partner, doing that at that point. And so we ended up being in a situation where we were stuck with an equity partner, and we quickly realized that we didn't have really like a strong backup plan, which was our mistake. And we ended up losing that equity partner at the last minute, at the 11th hour, like a few weeks before closing. And we couldn't take down the deal at that point. So, we didn't lose any investor money, but, the different partners lost earnest money deposit on that deal.
Yeah.
So the lesson learned for me, and that's what I'm trying. I was just talking to a student earlier. You don't want to be the first, for instance, working with a property manager in a market that they don't know yet, right? I think you can afford to take risks later on. However, you don't want to take risks and be the first when you begin, because that will, it will be discouraging, and it will be hard on your wallet, and you don't want to face this type of issues when you start the business.
Yeah, interesting. So myself, I never went the mentorship route, so I'm always fascinated by people who do that, and then you have the opportunity to learn from somebody more senior and stuff like that. That's good. So sort of got you back on track, but as you said, didn't lose any investor money, right? Just the risk capital was the only thing that was gone at that point. Yeah, difficult when you have a single large partner like that. I've heard of a lot of deals that fell apart at the last moment. If the big fish pulls out, then unless you have a lot of smaller fish oversubscribed for those shares, kind of difficult situation.
Right, and I think this is where there's a right sequence, and maturity when you operating these deals, then you can scale up, but you have to do it step by step, right? And I think so not only you're not going to go from a $3 million deal to $30 million deals. That's like the step is too high. So even though you could use these partners I just described, it's probably better to do it gradually instead of taking, again, it's all about taking risks. But again, I think there's nothing wrong with taking risks. You have to recognize what you can lose. And I think, the other side of it is how do you mitigate the risk and the risks that you face. And I think if you're aware, you're aware of the risks pertaining to the losses, but also, you're taking steps to mitigate those risks. This is how you can navigate these waters. Because I think at some point it's like when I did my first deal, and I did it with some partners. Now you're taking a risk there with you're working with people you didn't work with before. Even if they have a reputation, you don't know, right? You don't know what it's going to be like. But again, you have to. So, is it okay with you to lose sweat equity? Is it okay to you to lose some money at risk capital? And how much? It's like obviously you don't want to put all your eggs in the same basket either. So, I think to do things in a gradual manner, that's the right steps, the right way to approach it.
Yeah, good. And I love the theme of risk. Let's go a little further on that. We have an issue where now we're recording in the middle of July, and we still don't have our official statistics to tell us that we're in recession, but everybody believes that Q2 is going to be negative, and we're going to be officially in recession. So let's start with interest rates. Is there anything you're doing different in your execution or the deals that you are approaching as a result of higher interest rate environments?
Yes, several things actually. So number one is you certainly want to avoid high leverage, because there's more risk. Higher leverage implies more risk. As we just discussed about risk. The higher the leverage on your debt, the harder it will be. The higher the debt, to pay the interest rate. The interest payment, right? And the harder it will be to be break even with a lower occupancy, for instance. Because the direct result of being in a recession probably is going to be end up being in layoffs. So layoffs means people cannot pay their rent. Now, how much can you sustain in vacancy, at least economic vacancy, until, it becomes, you cannot pay debt. Because if you happen to be in technical defaults, then your debtor can repossess the property, which that would be the terrible place to be. But I've heard very, very experienced operators who have witnessed that 20 years ago, for instance. So one thing is so lower your leverage, and the other thing that you want to take into account is the interest rates increasing, as you just mentioned, George. So do you want to go with a fixed debt, or do you want to go with a variable debt? So obviously variable, it becomes very risky because interest rates are getting higher, and we don't know when it will turn around. It may not turn around until the inflation is under control and back to the 3% range, which could take months and probably years to get back as low as 3%, which is the goal of the Fed. So you want to go in fixed debt on your deals, avoid the uncertainty, and even I was playing with some students working on some models, modeling some forecast on interest rates and the cost of buying a cap on these variable interest rates. And we realized that, especially at the price of the interest rates cap these days, it's not cost effective to buy the cap based on the forecast that is available to us. And I'm talking about the forecast about the interest rates.
Right.
Now, it may be true in that case, but based on that forecast, we don't know if the forecast is going to be accurate or not.
Right.
So now you're taking a risk, not to take, I think you need some kind of insurance. That's why I mentioned fixed debt, fixed interest rate debt. The other thing that to take into account is, what's the cost to exit that deal? Because are you going to have a prepayment penalty, which could be yield maintenance?
Yes.
Meaning it's linked to the treasuries,
Mm-hmm.
or do you have a predefined step down prepayment? Like 5% of the debt, 4%, 3%, 1, 2, and 1. I prefer to have some certainty on my exit. That's why I like currently I've never liked refinance, for instance. I think it's silly to say, oh, we are going to do refinance 3 years from now, because you just don't know where the interest rates will be. They could be in your favor, and they could be in your disfavor.
Yeah, I think a lot of great suggestions you pointed out there. So you can get an interest rate cap, may or may not be cost effective. We don't know where rates are going. And prepayments, yield maintenance, defeasance, these step down regardless. It's expensive. And we don't know, rates could come back down again. So do you want to lock in for a longer period with this uncertainty, or do you want to maybe get a shorter fixed term and possibly have to refinance at a higher rate, or maybe take advantage of lower rates? It's definitely not easy. It was a lot easier when rates were coming down slowly and stably over, almost a decade or more. Wow.
Yeah, it's interesting because actually my second deal, we purchased it during the last time frame where the Fed was raising rates. And I remember I was talking to my lender, and it was a deal which ended up working great actually. But the lender was calling me like every couple of weeks, saying, oh, we just increased, like the rate increased, 10 basis points or 5 basis points, like every week it was like that. And we're like, I was telling my partners, like, we need to pull the trigger on this, otherwise, it's going to be bad for us on the debt side. But again, learning from, at that point, learning, I guess. And we did yield maintenance for the exit. And for the longest time, the treasuries were so high that yield maintenance was just killing our returns until that changed earlier this year, and that's when we sold a few months back, and the yield maintenance ended up being very affordable.
Yeah, always something to consider. It's very expensive to get out of loans sometimes. Now, let's maybe move on to what I would see, at least I would see a different aspect of yield maintenance is your markets. What sort of markets are you looking in these days? And I wonder, is that driven by concerns of risk or more out of desire for return?
Well, so, I think for a long time, I was looking at Memphis, and a lot of places in Alabama, such as Mobile and Birmingham, as well as Montgomery. I think the general consensus, even though, I think I believe in those markets, those are good markets, often very, and I think they're pretty resilient when there's a recession. Some of the investors, they became a little tired of those markets. Even though we try to explain those markets, like some people would never invest, they were not interested. At the same time, I remember when we met at a conference a couple of months back, or last month actually, I think it's important to follow the trends and where people are moving. And I think it's a better choice of market. So right now I'm looking a lot at Carolinas, Texas, and Arizona. And I think as we're following the migration trends, and moreover following business migrations trends, and there's a good reason for businesses to move in those areas, and we're just following where people are moving overall. So I think that's the best. That's those are the safest markets to look at. At the same time, you don't want to keep a 15% year-over-year rent growth in your underwriting. That's going to be that would be unadvisable to keep such high rent growth. But conservative underwriting in those growth market, I think that's the way to go.
Yeah, I like it. So you mentioned many things there that I'd love to dig into. First, when you talk about businesses moving to a state, Texas, I think tops the list. That's a very exciting state that's done an amazing job of bringing so many companies, not just Tesla relatively recently, but so many companies going to Texas. And I also enjoyed your take on the Alabama markets that you were in. You said that maybe they're a little bit more stable, maybe not as exciting in a certain sense, like Phoenix, Arizona, and some of these other places that people have seen some amazing exits, right? Some very quick exits. Maybe you get your equity mult in 1 or 2 years, and that's very exciting. But I wonder, though, if that conversation is going to shift as we move into recession. I expect that these more stable markets are going to become a lot more exciting. That's my theory, and that's been what's driving where I'm looking for new deals.
Yeah, I'm forging an opinion on this as we go, because it's interesting. Since I started, so we had the Black Swan event with COVID. Obviously huge changes in the uncertainty at that point. So it was really tough to sell. Basically the real estate market froze for a year. And then, there was the questions like, how we're going to be able to go through this. It's like everybody's losing their job left and right. But, I think those markets, they resisted well, right? Memphis, Alabama as a whole market. But, at the same time, that's when we started to see these shifts, people moving and companies relocating, etc. So, I think I do believe, in the growth. And I think, especially where companies are deciding to move, automatically people will follow these companies. And, as long as there is such a trend, and you have, like you mentioned Tesla, building the factories, etc. So, there's the building phase that's going to be like the employees coming in, and then people supporting the employees, and, other third parties and so on for the supply chain. This is like a once a company decide to move, and I believe Toyota decided to move as well recently to their headquarters to Texas. This is like, this will take several years. This is like a huge train, long train, freight train, like the ones that measure 2 miles and you have to wait 20 minutes at the intersection for them to finish. But you don't turn around those trains in a short time frame, right? It's going to take years and years for them to move. And I think there's going to be still people moving, even if there's a recession. They're not going to decide to move their facilities back to or somewhere else again. It will take several years for them to finish.
Great analogy too. Yeah, some of this states just like a total tsunami of jobs moving in one direction. It's quite amazing to watch. You mentioned before getting into real estate, you worked in several leadership positions. So obviously you're a mentor, a leader. What would you say is the best leadership lesson that you've learned in your life?
I think it's, what made me successful in different projects. I was a project manager, then team manager. It was to really spend time with people to really understand, make sure that I understood what people are doing in their job. For instance, when I was a team leader or manager, and also project manager, understand people what to do, what the project means for them, and how the project should fulfill their requirements. I was working in IT initially in my career, and when we are coming with these new projects, these new software with people, it was not necessarily like a welcoming environment. People, they were like, well, I'm doing things this way and it's working well for me, I don't want change. Right? So it was very important to sit down with them and understand. Right. So how can I help you? We have technology here, we can help you do great things. In the long run, it will save everybody money. You have to understand. And I think I was doing actually a personality profile recently, and I was like the ambassador was my profile. It's like really like try to talk to people, understand what they want, and convince them, but not make sure to understand what they need and see how the project will help them achieve that. That's a very important, and I think that's, if you apply that to business, and entrepreneurship, I think when you negotiate in general, you want to spend the time to understand what your partners want. It could be a seller, it could be a vendor, and make sure that you can make this a win-win situation, like when everybody can benefit of the relationship.
Great. And I love the analogy to real estate and negotiations. Perfect. So just understand all the stakeholders in the situation and what everybody's looking for, find that win-win. Good stuff.
Thank you.
All right. So I'm telling you something, I'm going to try to do something new here today. I'm trying to be a little bit more terse. So some of my interviews have been going on an hour, and I'm going to try and see what it's like to make things just a little bit shorter and see if we can maybe attract a different audience. So are you ready to go into the lightning round?
I am.
All right. Tell us something about one of your real estate markets that most people wouldn't know.
Well, I will get back to Memphis, which was my first market, and the market I know very well. And, it's, and I kind of mentioned that earlier, for some reason, market has bad reputation. And I remember even when I was at the very beginning of my multifamily career, I was talking to my friends about Memphis, and they were like, no, you're crazy, you shouldn't invest there, it's terrible. And it's not. It's like every other market, actually. So on one hand, you have reporting of crime that is a little bit different. And from a statistical standpoint, it could look like an oddity with high crime, whereas there's no more crime, particularly than everywhere else. It's similar. And after it's about when you invest in a market like that, you need to know the different submarkets, the neighborhoods, right? And I know people are investing in tough neighborhoods and they're doing very well there. I prefer more kind of neutral, where crime is not very high neighborhoods. I think it's a better choice personally. But again, there are no bad neighborhoods per se. It's a very good market, Memphis. Especially, it's a very large market. It's 1 million plus people MSA, and it's diverse employers, a lot of healthcare and transportation, etc. So, don't underestimate Memphis.
Okay, I love it. I love barbecue too. So great pick, Memphis. How about some advice that you would give your younger self?
I wish I would have spent more time on real estate at a younger age. I came a little bit later to real estate. Initially I was looking in the stock market and spent a lot of time on it as a side hustle. But yeah, I think that's real estate is the way to invest and grow a portfolio. I think protect also your investments, growth.
Right. So the next two, I think, are just perfect for you because as a mentor, obviously you're giving advice to younger and newer real estate investors. The first one will be, what is the best real estate advice you've ever received, or what is the best real estate advice that you'd like to give on this show today?
Well, yeah, I have, 3 things that I keep repeating to my students. Number one is don't, and we're doing, so students, I'm helping them find deals, underwrite deals, and then, run the transactions until close, etc. And I see, what happens is they're looking at older deals and they underestimate how much it costs to operate an older deal. And this, and I'm talking about the 40, 50 years old plus properties. Mm-hmm. It does, even though they may look nice and in good shape, inspections, they may not necessarily show you the whole picture of how much it costs to operate. Mm-hmm. And there will be a lot of things to look at, between, and I'm talking experience there. So roofs, siding, they could be the different, like the trees, for instance. You always have the lender, you will want to trim trees, you don't want to have any branches above the roofs. How many deals have done, we kind of underestimated how much it costs to do this type of task. Also like the parking lots and all these things. The second advice is you want to pick a property manager that is doing, taking care of properties, similar properties that the one you would like to have managed. Meaning same neighborhood, same size, same vintage. Don't be the first, which I mentioned earlier. You don't want to be the first with a PM on them doing management of a property, in a neighborhood they don't know, or a size of deal that they don't know. That's taking a risk. The PM is the most important factor in your success. They will make the deal a success or make it a failure. Actually, is that important? And the third one is, I mentioned earlier, mention it again, is you want to have some level of certainty on your exit. Prepayment, penalties on your loan, fixed debt, no refi.
Excellent. What's the worst advice you've ever received, or what is a pitfall that you'd like to help others to avoid?
Well, the pitfall, it's like, again, I go back to being the first. You don't want to be the first, and it's okay. I'm not saying don't do it 100%. I would say do it if you're comfortable with the risks and if you have a backup plan. That's where you being the first, you can in a strategy, in a market, you can lose your shot on this. So Yeah, or talk to your mentor.
Good.
That's the counterpart to this. Talk to your mentor about this.
Great advice. All right, so now this is where we take a nod to the randomness of the universe. So I have some random question cards. This could be literally about anything, Philippe. So just tell me when to stop cutting the deck. We'll take the top card.
Stop.
Okay. Which event in the past, present, or future would you like to witness in person?
Oh, wow. You know, I think that's a great question. That's a great question. And, you know, I as a matter of fact, I think often about this question, you know, like time travel and so on, kind of a interesting philosophical question for me. And, you know, I think there's so many, I would probably say like the birth of Christianity is a great, it would be a great thing to witness. You know, I'm very interested of being there and see actually what happens.
I love it. This is amazing. We ask these random questions and sometimes they get the most profound answers. So thank you for that. All right. So now back to the more mundane world. Name a book that's helped to forge you as a leader or as an entrepreneur, and why.
So the book that really changed my perspective on a lot of things was The 7 Habits of Highly Effective People of Stephen Covey. And, you know, even though it has kind of a catchy marketing-y title, you know, I think it's very profound what Stephen Covey talks about in that book. You know, a lot of great advice, a lot of you know, the power of the habits and the, you know, all of the habits, you know, the first one being be proactive, kind of opened my mind on a lot of things, you know, through my personal life, particularly more than my professional life, actually.
Outstanding. I was about to ask what your favorite habit is, so then I'll just give you mine. Mine is number 7. Do sharpen the saw. It's so easy to forget when you have so many things you need to do each day. So sharpening the saw, number 7. All right. Probably the hardest question in the interview. How has a failure or misstep set you up for later success?
Yeah, so you asked me about the misstep before, but so how did it set me up for success? I think it's more about like a general philosophy of life and being an entrepreneur overall, which is, you know, anything you will face difficult times, you know, and I kind of go back to the 7 habits and be proactive. It's really what will define you is how you will react to what happens to you, right? You cannot spend your time on you know, complaining or what happens to you, or you know, I think it's obviously in some cases it's okay to be sad and take the time, you know, for grief, for instance. But what will define you is how you will react to things and react how you react to what happened to you and circumstances. And so when you have some difficult times and, you know, you have a project that doesn't work out, you know, I would say just don't give up, right? Just, you know, decide to learn from your experience and just continue to push forward and make the best out of it, and, you know, put it in your baggage, in what you know and what you can teach to others, and move on.
Great. I love it. Reminds me of a quote from Charles Dobbins, who I think is going to come just a couple of weeks before this is released. And he says that success is a poor teacher. So I gather that you would agree. It's the adversity. That's what strengthens you and forges you as the person you become. Perfect.
Absolutely.
All right. Now, have you got a quote for our audience to help forge them as leaders and entrepreneurs?
Yeah, sure. Again, you know, I'll be consistent with the 7 habits and Stephen Covey. You know, it's like his quote, and I'm paraphrasing a little bit. You know, I prefer in that order. It's, I am a product of my decisions, not my circumstances.
Beautiful.
That's the proactive habit number 1.
I love it. All right, wonderful, Philippe. And then just one final question. Tell our audience where they can reach you.
Sure. So people can reach me at on my website, boostmycapital.com. or send me an email at Philippe, it spells PHILIPPE, at boostmycapital.com.
Outstanding. Thank you so much for sharing your experience with our audience today.
Thank you very much, George.